In today's mailbag episode, we're going to talk about whether or not you need life insurance in retirement. We're going to answer a question about how to inherit different account types and help pay as little tax as possible on that inheritance, and then also tackle a question on non-retirement accounts, a brokerage account generating dividends and ways to help make that account as tax efficient as possible. These are great questions that you may be able to relate to or learn from, so that way we can continue to help you build wealth and reduce your long-term tax picture.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome to the Retirement Show, all about your life, your money, and your taxes. I'm your host, Scott Searins, and my goal is to help you thrive in life, wealth, and retirement. And in today's show, we've got a lot of great questions that came in, so we're going to give you a lot of great information. I think you'll really relate, whether you're someone that's just going into retirement and wondering if you need life insurance, if you potentially have an inheritance coming in. We're going to talk about taxes on inheritance. And then last, if you're an investor in a non-retirement account, sometimes called a brokerage account or non-qualified account, we're going to talk about how to make sure your investments are tax efficient in that non-retirement account. Now, for those of you that are weekly listeners, first off, Happy New Year to you. I hope that you had a great holiday season. And for those of you that might be first-time listeners, we have a great weekly email that goes out to help you build wealth, to help you reduce your long-term tax picture, and to help you be prepared for retirement. You can go to lifemoneyshow.com. Again, that's lifemoneyshow.com. You're going to scroll down and you want to fill in the section that says Join Our Insiders List. Again, that'll get you our weekly email full of thoughts, strategies, actions to help you in your financial future. So as I mentioned, we had some great questions come in. We're going to talk about tax-efficient investments for non-retirement accounts, taxes on an inheritance, and where we're going to start is whether or not you need life insurance in retirement. And specifically, this question was asked by a couple that has an age gap in the relationship. However, the answers that we're going to talk about today, you'll be able to potentially relate to all of them, or they all might relate to you, and hopefully you can have some takeaways to utilize them in your specific scenario. So let's start with question number one, and hopefully you find all of the responses, the thought processes, the strategies to be of value and benefit in your overall situation as well. Here we go. First question comes in from Alexis. Alexis says, my husband, Jack, is 13 years older than me and he's retiring next year. The only life insurance that he has is what's provided by his job. So when he retires, he's not going to have any life insurance. Should I take a policy out on Jack since I'll probably outlive him by several years? So let's just first slow it down. What do we have going on in this situation? So Alexis and Jack, there's a 13-year difference. Jack's at an age where he says, I'm ready to retire. He's going to retire next year. And so what they're wondering is that since Jack's retiring, do they need to take a life insurance policy out on Jack to help provide for Alexis? Now, one of the things that I've recognized as I meet with new people is for some reason our brains have been maybe conditioned that everybody needs life insurance. I don't know if that's just as we're growing up. There's a lot of life insurance salespeople out there, and they're pushing us to get life insurance in case something happens, which, don't get me wrong, there's a lot of great reasons that we need to have life insurance. That's why it exists. But it doesn't always mean that we have to have it through our entire lives. And so I think what we need to do is really slow this down, go back to the basics of life insurance and why someone would get life insurance, to then help you determine, do you still need life insurance after Jack were to retire? So let's just kind of start with the basics. Why do you get life insurance? Well, life insurance provides a lump sum death benefit to help replace the financial value that Jack has brought to the relationship when he were to pass away. So that lump sum comes when Jack passes away. So let's just because I want everybody to be able to learn from this, let's start with a younger age and then go to the retirement age. So let's say Jack's 43 and Alexis is 30. And I'm just going to make up, they didn't provide it here, but let's just say they have children as well. Well, At that younger age, with a family involved, with children involved, and maybe just because they're getting started in life, they don't have as much saved, life insurance would be to replace the income and the value, the ongoing value, financial value that Jack would bring to the table in this scenario, right? They're worried about Jack passing away. So life insurance would be to replace the income of the person that passed away to help pay off any debts, to help kids get through college education, and to help replace Jack's income, if he's 43, from age 43 until he were to be at retirement age or even longer, right? In that way also, so Alexis and the children can continue to live their life without being, I'll say, in like financial ruin. They can continue to maintain their lifestyle just as they had as if Jack were alive. So it's not going to put them in a really bad position or bad spot if Jack were to pass away. And so that's, life insurance at a younger age, that's exactly what that's for. If you're to lose one spouse, can the remaining spouse and the children continue to maintain their lifestyle? Can they pay off those debts? Would they be able to go to college? Whatever the plans were before, can those plans remain after? Now, let's just fast forward in life. Alexis and Jack, right? Jack's now at that retirement age. Alexis is younger. She's going to keep, and according to this, she might still be working. Maybe so, maybe not. So what about at an older age? Do Alexis and Jack still need life insurance? And there's a really key point that comes into play that Alexis didn't mention in her question here. And that key question that comes into play is, how much do Alexis and Jack have saved up? And you can look at your situation here, Alexis, and say, okay, do you have enough saved up that you could still maintain your lifestyle between your income and what's saved up when Jack passes away? So if you have enough saved up, and between that and your income or any other spousal benefits that you might get if Jack passes away, if you've got enough saved up, well, no, then you don't need life insurance. But if you don't have enough saved up and you would not be able to maintain your lifestyle, well then yes, you might need life insurance. So it comes down to a question that simple. Jack passes, would you still be able to maintain your lifestyle between the income that would be coming in and what you have saved up? Now, I find a lot of times, as I mentioned before, our brains just get conditioned to the fact that everybody needs to have life insurance, and that's not necessarily the case. Instead, you just need to go through this simple question. Jack passes, would you be able to maintain your lifestyle between what's saved up and the income that you would have coming in? And when we go through simple questions like this, I find I can tell you many stories. People that come in, they have life insurance. They've been paying on this life insurance for years and years and years. But when we look at it and they have $1 million or $2 million or more saved up, and we ask these questions, when they actually start to answer these questions in their minds, a lot of times they recognize that they don't need life insurance any longer. And sometimes, and I want to just bring this up too, you need to look at and review your life insurance. Maybe you've built up a significant cash value and there's now time to utilize that cash value. You can utilize that as part of your retirement savings. Sometimes you're still paying on life insurance. Sometimes you might think, well, I'll just keep paying on this because the premiums right now aren't necessarily that high. But when we call the life insurance company and go through, are those premiums guaranteed? A lot of times those premiums aren't guaranteed for life. And so when we're talking and going through all the questions to understand their policy better, what they find out is that their premiums will continue to increase over time. Or their premiums might stay the same, but then the life insurance company will help them understand that they're actually going to start taking from the cash value that's built up to pay off the remaining portion of the premiums. Because as you get older, typically, depending on the life insurance policy, the cost of insurance is going to go up. So again, sometimes it's just going back to the basics, understanding that one simple question, yes or no, and then that'll help you understand, do you need that life insurance? Now, since we're talking about this, since the question actually came in about Jack going into retirement, Alexis being younger, needing life insurance, I wanted to get you to think a little bit differently And what I find is the more natural transition at retirement is that you go from life insurance to long-term care insurance. Life insurance only pays when you pass away. But what if, I'm just going to use names here, right? Because it's come from Alexis and Jack, and I want you to relate to this. What if Jack were to go into a nursing home for 5 years or 7 years or 10 years? And, the average time frame that somebody goes into a nursing home might not be that long, but I just want to really get you to think worst case scenario here. So let's just say, what if Jack went into the nursing home for 5 or 10 years? Well, let's say you were then planning to live off that retirement savings that had been saved up. Well, and let's just say a huge portion of that retirement savings is going to pay the nursing home. Alexis, this could actually put you in a tougher position that while Jack's still alive, that majority of the money that the two of you have is going to pay the nursing home bills. And this is why I see people transition from life insurance. See, life insurance wouldn't help in this situation because life insurance isn't going to pay until Jack passes away. But this is why I see people then transition to long-term care insurance. Long-term care insurance is going to help, if you had it, it's going to help pay that nursing home bill, helping to protect your retirement savings. And so that way you can continue to maintain your lifestyle while Jack is in the nursing home and continue to do the things that you want to do. So just something to think about there. The whole situation, whole scenario here is where I'd say, hey, go sit down, talk to a financial advisor, a financial professional specific to your situation, to what you have saved up, to how much income that would be coming in, to what would happen if Jack were to go into a nursing home. So that way you can decide what is needed specifically to you. Maybe you need life insurance. Maybe you need life insurance and long-term care insurance. Maybe you don't need either type of insurance. And it's all going to be based upon what you have saved up and what kind of income that you're going to have coming in. So, Alexis, great question there. Hopefully my answers and thought processes have helped you along the way as well as many others. And I hope it leads you down the path of determining what you specifically need for your and Jack's life. Okay, so our next question comes in from Ron. Ron says, I have an after-tax account with some investments that pay really nice quarterly dividends, but those dividends also create a substantial tax bill each and every year. Should I invest in something different in this account? Ron, as you know, I love talking about taxes because my goal is to help you keep more of your hard-earned money in your pocket versus giving it to the IRS. Each and every year with our clients, we do a year-end planning and tax strategy meeting just for this reason, because we want to help our clients keep more of their hard-earned money with them versus paying it in that tax bill that you're talking about to the IRS. So let's just kind of back up for a second so we make sure we understand Ron's full question here. Ron says he has an after-tax account. Well, if we back up and really think about it, on the show, we've talked about the 3 tax buckets many of times. So the 3 tax buckets are the taxable bucket, the tax-deferred bucket, that would be like your IRAs, 401ks, 403bs, 457s, and then the tax-free bucket. The tax-free bucket would be anything that says Roth in front of it. Well, what Ron's talking about actually goes into the taxable bucket. So he said an after-tax account. Sometimes it's called after-tax account. Sometimes it's called a taxable account. Sometimes it's called a non-retirement account. Sometimes it's called non-qualified account. Sometimes it's called a brokerage account. Lots of different names. Hopefully I've gone through them all. So just in case you're wondering, where does this fit into your picture, you can now relate to it. So Ron's got the after-tax account. And what does that mean? Well, it means that he gets taxed each and every year on interest, dividends, and recognized gains. Why did I bring, I know he's talking about dividends here, but why did I bring up interest? Because say you're somebody who has a checking account or a savings account or a money market account. Well, that's an after-tax account as well. Maybe you have a online savings account. Well, you're going to get taxed on that interest each and every year. But Ron's specific question here was basically as a brokerage account. And in that brokerage account, he's got investments, and those investments are paying dividends, nice dividends each and every year, creating a substantial tax bill. Well, first off, let's understand how dividends are taxed, because this might be something that Ron wants to take a look at, because based on the investments that he's got in there, he might just, the dividends alone, the investments that he have, might be tax inefficient in themselves. And let me explain that for a second here. So when it comes to dividends, you can have ordinary dividends or qualified dividends. Right here, just that, the type of dividends that you're being paid out can make a really big difference on your tax bill. So ordinary dividends are taxed at your ordinary income tax rate, meaning 10%, 12%, 22%, 24%, 32%, 35%, or 37%. That's right. If you've got dividends coming in and they're ordinary dividends, they could be taxed at any one of those rates, dependent on how much income that you have coming in. Or they could be qualified dividends. Now, qualified dividends are taxed at a more favorable rate. They're taxed at the long-term capital gains rate, which would be 0%, 15%, or 20%. And that's all based on how much income that you have coming in, but typically it's going to be less than your ordinary income tax rate. So first off, I would say, Ron, take a look at your tax bill. See out of your dividends how much are ordinary dividends and how much are qualified dividends. If you have a heavy amount that's ordinary dividends, but you really want dividend income, well, then maybe you want to look at switching around the investments that you're in and looking at funds that are going to focus more on providing you qualified dividends at a more favorable rate. Now, the other thing you're talking about, should you be investing in something different? Should you be doing something different? Is there a more tax efficient way of doing this? Well, you could choose funds that are not focused on paying you out dividends and instead focus on capital appreciation, meaning you're just focused on the value of the stock going up. And the benefit of doing this is that if you hold the stock or hold the fund for more than 1 year before you sell it, then any gains that you have are going to be taxed at that more favorable rate, that long-term capital gains rate. However, a lot of funds will always, or not always, but will most likely pay a dividend. It's just there are funds out there that are more focused on dividends, and there's funds out there that are more focused on capital appreciation. It's dependent on really what you need for your situation. If you really need dividends to maintain your income in retirement or wherever you're at, well, then maybe you need to focus on dividend income and just look to make sure it's more focused on qualified dividends. Maybe you're younger in life, you've got other income coming in, you really don't necessarily need the dividend income, and it's just creating more tax liability for you. Then you want to maybe choose funds that are more focused on capital appreciation. Or if you need a blend, then you can kind of find something that does both for you. But understanding how everything's taxed, or understanding also that you can, just have funds and take a more total return approach and over time sell, but you kind of want to be waiting past that 1 year so that way it's long-term capital gains, that can help you drive more tax efficiency in this after-tax account, or for others that are listening, a brokerage account, or it could be called individual or joint account, whatever it might be in your specific language. It's just a non-retirement account, and hopefully that helps you understand how to drive tax efficiency in that non-retirement account, focusing on the type of dividends, focusing if you're selling, right, instead to get income, instead of using dividends to get income, you're just going to sell and take gains. Well, at that point in time, you want to focus on more longer term approach, meaning longer than 1 year. Either way, getting yourself to those long-term capital gains versus getting taxed at your ordinary income tax rates. Ron, thanks for sending in your question. As you can see, taxes can be a very confusing subject. This is why it's something that we go over with our clients each and every year, coming up with a strategy and a plan to help them reduce their long-term tax burden in their life, because it is confusing. There is a lot of parts and pieces going on. We just spent 10 minutes talking about a brokerage account, an after-tax account, but then you add in your retirement accounts, you add in a Roth account, maybe you're still working and saving, and then you're saying, which buckets do you actually save money into? And you can take one approach, which is just kind of winging it, or you can take an approach of having a plan in place, just like Ron's thinking about here, what should his plan be to help reduce his long-term tax burden, keep more of this dividend income that he's got coming in his pocket versus giving it to the IRS. All right, with that, let's move on to our third question for the day. Comes from Leah. Leah says, my mom just passed away, and I, along with my aunt, am in her will. I'm going to get about $300,000. Now, some of it is in an IRA, some of it is in a TOD, that's transfer on death, TOD account with several different stocks. How should I handle these different assets to be able to pay as little as possible in taxes? Well, Leah, thanks for sending in your question as well. Your thought processes align with mine. How do we pay as little as possible in taxes? Well, first off is, just like you're doing here, Leah, is the great job on recognizing that you need to get some help. And this is where most people go wrong. Instead of realizing that they need to get some help, they just sell everything. They get, cut everyone a check, and they end up paying more in taxes than they would have if they were to actually just take their time and get someone to help them through the process. Now, for everyone else listening, Leah's already done one key part that a lot of people will pass over. And that key part is understanding which tax account types that she's going to be inheriting. Now, in this case, she's inheriting two different tax account types, and each should be handled differently. So one account type that she said she'd be inheriting is an IRA. Now, this is money that has not been taxed yet. When it comes to IRAs, 401ks, 403bs, 457s, any money that is taken out of those funds, out of those tax buckets, we're going to pay ordinary income tax on every dollar that's taken out. Now, most of the times what you want to do if you're inheriting an IRA is you're going to roll it into what they call as an inherited IRA. And that's a non-taxable event. So when you roll over, it just goes from in this case, your mother's IRA into a specific account. Now, just not your IRA. You don't want to roll this into your specific IRA. It's a specific account called an inherited IRA. Sometimes people also call it a beneficiary IRA. There's different paperwork that gets filled out for this type of an account. But you roll it into the inherited IRA, and when you do that, it's a non-taxable event. Now, any IRA inherited after January 1st, 2020, if it was, again, rolled into an inherited IRA, you have 10 years to take out all of that money. And you might have to take required distributions through those 10 years, but you have 10 years to take it all out, meaning that you can break your tax liability up over that 10-year period. So why is that important? Well, let's just use an example here. Now, Leah said $300,000. Well, if Leah were to take and inherit that, let's just say all of that $300,000 was in an IRA. And I'm just going to take this one step further so we can really understand the difference in using an inherited IRA versus just taking a lump sum. Let's just say the amount Leah was getting in an IRA was $750,000. Well, if she sells all of that at once, for one person, that would just put them in the 37% tax bracket. So now on that $750,000 inheritance, she'd be in that 37% tax bracket and paying tax on all of that money. However, on that same $750,000, if she were to roll it into an inherited IRA and then utilize that 10-year rule, she could just take $75,000 a year, which would most likely be at a lower tax bracket than if she took all one lump sum. So don't forget, when it comes to IRAs, there's a special way to inherit them. Make sure you talk to a financial professional about utilizing an inherited IRA and whether or not you should do that specifically for your situation. But quite possible it could help you reduce and lower your long-term tax burden. Okay, so our next account that Leah said she's inheriting here is a TOD, transfer on death. What is that? Well, that's a non-retirement account. A lot of times it could be called a brokerage account, individual account, joint account, non-qualified account. It's anything that's not an IRA, 401k, or Roth is what she's inheriting. Now, For this account, and this is why I said you got to understand the tax account types that you're inheriting. For this account, what really might make sense is that she sells it immediately. And here's why. Right now, there's a rule called the step up in cost basis, meaning that when Leah's mother passed away, Leah got what's called a step up in cost basis. Let's just say, we're going to use big round numbers here because it's really going to help you, hopefully help you understand it. Let's just say Leah's mother bought these funds, and when she bought the funds, the value that she paid for the funds was $100,000. Let's say then the value increased over her mother's time to $500,000. Well, that's a $400,000 gain. And a lot of times right now we're probably going through our minds, wow, a $400,000 gain. Yes, that could mean a lot in taxes, but it could have only meant a lot in taxes to Leah's mom. When she passed away, Leah got the step up in cost basis, meaning the value that Leah inherits these at is $500,000. There's the $400,000 of gains. You can almost look at it like that tax value goes away. That's the step up in cost basis. So the original cost basis was $100,000. There was the gains over Leah's mother's lifetime, but then when she passed away, the new cost basis became $500,000. So Leah doesn't owe any tax on any of those gains that her mother had when she was holding them in her account. As you can see, this is a way to pass money between generations and kind of remove that overall tax liability that you might have in any sort of the gains in the account. And so why did I say sell immediately? Well, when her mother passes away, that's when Leah's new cost basis starts. So if Leah decides to just hold on to them for 6 months, and in our example here, the value goes from $500,000 to $550,000, and then Leah sells, well, she now has taxes that she's going to pay on that $50,000 of gains. And if she's just doing that over 6 months, her mother passed, 6 months later she's selling, well, those gains she's going to have to pay taxes at her ordinary income tax rate. So this is why sometimes it makes sense just to sell right away and then invest according to your situation or your plan. So that way you can do what's right for you over the long term. So instead of selling over 6 months, you can hopefully wait past 1 year, and then you're looking at long-term capital gains rates, which are more favorable than those ordinary income tax rates if you were to sell it like 6 months. So this can get it's simple, it can be complicated at the same time. Hopefully you see just the benefits of transferring those brokerage accounts from one generation to the next generation from a tax standpoint. Hopefully you can also see the benefits of why you would want to sell those types of investments right away. And those are, a lot of times investments that it makes more sense to wait until your mother passes away before you actually inherit those versus getting them prior to when she passes away because of that rule of the step up in cost basis. So 2 different tax account types. If you're inheriting anything from a parent or a friend or whatever it might be, but if you're inheriting money, hopefully this has made it register to you to, 1, know what kind of tax account types you're inheriting. If you're inheriting an IRA, you want to do that in a special way, in that special account called that inherited IRA. And if you're inheriting any sort of non-retirement dollars, well, you should be paying attention to the day that person passed away, registering what that new cost basis is, as we want to make sure that you get the step up in cost basis and that you're not paying taxes on all of the gains of that the deceased person had in their accounts. Leah, Ron, and Alexis, thanks for sending in all of your questions. I hope the thoughts that I've provided you today provide you or others listening a lot of value and benefit in your overall personal financial situation and scenario. Our goal is to help you thrive in life, wealth, and retirement. And so hopefully our responses today did just that. Again, if you're a first-time listener, go to lifemoneyshow.com. Again, that's lifemoneyshow.com. A couple things that you can do. You can click on today's episode, and on the screen there, you'll see where you can actually type in a question that you might have. We'll be happy to answer it on the show. Also, go to the homepage, scroll down, and sign up for that Insiders List. That's our weekly email to provide you thoughts, strategies, and actions to help you build wealth, to help you be prepared for retirement, and to reduce what you'll pay from your hard-earned retirement savings over to the IRS. Don't forget to subscribe on your favorite podcast player, and I look forward to our next conversation to help you continue to enjoy life today and be financially confident about your tomorrow.
Investment advisory services made available through AE Wealth Management, LLC, AEWM. AEWM and Searns Financial Group, Inc. are not affiliated companies. Insurance products are offered through the insurance business Searns Financial Management, Inc. Searns Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Searns Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Searns Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Searns Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Searns Financial Group, Inc. Bond obligations are subject to the financial strength of the bond issuer and its ability to pay. Before investing, consult your financial advisor to understand the risks involved with purchasing bonds.